Welcome to the program You Can Beat the Stock Market. Here we show you how you can beat the stock market, even though you're not a pro like Warren Buffett. I am Francisco, and today I'm going to bust 13 myths blocking your stock market profits. Limiting beliefs about stock investing are thoughts or ideas that may prevent you from realizing your full potential in the stock market. These beliefs can restrict your ability to make informed decisions and capitalize on opportunities. What's the difference between having a limiting belief that you can't beat the stock market and actually beating the stock market? The difference lies in your mindset approach and actions. A limiting belief can hold you back from taking necessary steps to succeed in the stock market. If you believe you can't beat the market, you might not make an effort to learn about investing or seek opportunities to grow your wealth. On the other hand, if you have a positive mindset and believe in your abilities, you're more likely to pursue knowledge, take calculated risks, and adapt strategies that help you achieve success. A person with a limiting belief may adopt a passive approach to investing, such as simply placing their money in a savings account or buying a bond market index fund. While these strategies can be useful for some investors, they may not fully capitalize on opportunities to beat the market. In contrast, someone who believes they can outperform the market may actively research individual stocks, industries, and trends, diversify their portfolio, and employ various investment strategies to maximize their returns. Limiting beliefs can lead to inaction, missed opportunities, or suboptimal investment choices. If you don't believe you can beat the stock market, you might hesitate to invest or make decisions based on fear rather than sound financial analysis. On the other hand, overcoming limiting beliefs that you can't beat the stock market is important because it can help you gain the confidence to explore investment opportunities, learn new strategies, and ultimately increase your chances of success in the stock market. When you challenge your limiting beliefs, you become more open to learning about stock investing, market trends, and effective investment strategies. This knowledge can empower you to make informed decisions and improve your investment outcomes. Overcoming limiting beliefs can shift your mindset from a passive to a proactive approach. Instead of merely accepting market returns, you may actively seek to identify and capitalize on investment opportunities that have the potential to outperform the market. By overcoming limiting beliefs, you can develop a better understanding of risk and how to manage it. This can help you create a more diversified and balanced portfolio, mitigating potential losses and increasing the likelihood of achieving your financial goals. Overcoming limiting beliefs can contribute to better investment performance over time, which can lead to increased wealth and financial security. This can help you achieve your long-term financial goals, such as retirement planning, funding education, or purchasing a home. As you overcome limiting beliefs, your self-confidence as an investor will grow. This confidence can spill over into other areas of your life, helping you to face challenges and pursue opportunities with greater courage and determination. Challenging your limiting beliefs encourages a growth mindset, which emphasizes learning, adaptability, and resilience. A growth mindset can help you navigate the complexities of investing and better prepared for market fluctuations and changes. By overcoming limiting beliefs about beating the stock market, you can unlock your potential, enhance your financial security, and cultivate a proactive, informed approach to investing. Some common limiting beliefs about stock investing include: the number one limiting belief about stock investing is too risky. When people say investing is too risky, they usually mean they're afraid of losing their hard-earned money in the stock market. It's true there are risks involved, but with the right approach, you can significantly reduce those risks and potentially grow your wealth over time. First, let's talk about diversification. By spreading your investments across a range of stocks, bonds, and other assets, you can reduce the impact of single investment's poor performance. So, if one stock or industry takes a hit, your entire portfolio doesn't collapse. Another way to reduce risk is by investing for the long term. Short-term market fluctuations can be unpredictable, but over the long run, the stock market has historically trended upward. By staying invested for many years, you can ride out temporary dips and enjoy the potential gains in the long run. It's also important to know your risk tolerance. Some people are more comfortable with risk than others, and that's okay. Understand your comfortable level and invest accordingly. You can choose more conservative investments, like bonds or dividends paying stocks. If you want to reduce your exposure to risk, finally, educate yourself. The more you know about investing, the better equipped you'll be to make informed decisions and manage risks. Read books, follow financial news, and consider attending an online stock investing course to help you build a solid investment strategy. So, is investing too risky? Well, like anything in life, there are risks involved. But with proper diversification, a long-term mindset, understanding your risk tolerance, and continuous education, you can greatly reduce those risks and make investing a valuable tool for building wealth. Remember, not investing also carries its own risks, like inflation eroding your savings over time. The second limiting belief about stock investing is, I don't have enough money to invest. This is absolutely ridiculous, and I'm here to set the record straight. Let's get this straight. You don't need a lot of money to start investing. I'm tired of people using this excuse. There are so many ways to invest with just a small amount of cash, and I'm going to show you how. First app, fractional shares. Many investment platforms and brokerages offer this amazing option. You can buy a portion of a share instead of needing enough money for a full share. Even those high-priced stocks become accessible to everyone. How great is that? Don't forget automatic investing plans. Many platforms let you set up recurring deposits, so you invest small amounts regularly. This strategy, called dollar cost averaging, lets you build your portfolio over time without needing a huge initial investment. Alright, I think I've made my point. The belief that you don't have enough money to invest is just plain wrong. With fractional shares and automatic investment plans, anyone can start investing. It's time to stop making excuses and start building your wealth. If this tip opened your eyes to the truth about investing, hit that thumbs up and share it with your friends. Subscribe to the channel for more no-nonsense financial advice. The third limiting belief about stock investing is too complicated. I'll show you 8 ways to bust this myth. First, let's talk about online resources. There's an endless supply of blogs, YouTube channels, podcasts, and articles out there to teach you the basis of investing. There's no excuse to say it's too complicated when there's a universe of information at your fingertips. Number 2, robo-advisors. These automated services build and manage a diverse portfolio for you based on your risk tolerance and financial goals. They simplify the process. So, don't tell me it's too complicated when there are tools designed to make it easier. 3. Investing mentor. These professionals can guide you through the investing process and provide personalized advice tailored to your needs. It's their job to make things less complicated for you. Fourth, investment apps. There are user-friendly apps designed to make investing straightforward and accessible. Many of these apps also provide educational content, so you can learn while you invest. Number 5. Community support. There are countless online forums, social media groups, and local meetings where you can connect with other investors and learn from their experiences. You're not alone in your investing journey. 6th, dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. It's an uncomplicated approach that helps reduce the stress of market timing. 7. Online courses. Many universities, community centers, and online platforms offer stock investing online courses for beginners. Attend webinars or sign up for an online course to boost your stock investing knowledge. And finally, number 8, practice accounts. Many brokerages and investing platforms offer virtual trading accounts where you can practice investing with fake money. This allows you to learn the ropes without risking real money. There you have 8 ways to bust the infuriating myth that investing is too complicated. With all these resources and the tools at your disposal, anyone can start investing. It's time to stop making excuses and start building your wealth. The 4th limiting belief about stock investing is, I need to time the market. Some investors believe they need to perfectly time their investments to maximize returns. However, trying to time the market is really impossible, even for experienced professionals. I'm here to demolish this myth, so buckle up and get ready for some explosive myth busting as I give you 8 ways to prove that you do not need to time the market. First up, dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals regardless of market condition. It's an uncomplicated approach that doesn't require you to time the market, and it helps reduce the stress of market timing. Number 2, long-term investing. Forget about timing the market. Focus on long-term. Historically, the stock market has trended upwards over time, so stay invested for the long haul. You can benefit from the growth without stressing about short-term fluctuations. 3. Diversification. Spreading your investments across different asset classes, sectors, and geographic regions can help reduce the impact of market volatility. This way you are not putting all your eggs in one basket and relying on your ability to time the market. 4th, focus on quality investments. Instead of trying to time the market, concentrate on selecting high-quality stocks or funds with solid fundamentals and a history of good performance. This can help you build a strong portfolio that's less reliant on market timing. Number 5. Ignore the noise. Don't get caught up in daily market fluctuations or sensationalist headlines. Stay focused on your long-term goals and investment strategy rather than trying to predict short-term market movements. 6th, historical data. Studies have shown that even professional investors struggle to consistently time the market. Most people who try to time the market end up underperforming compared to those who stick to a long-term buy and hold strategy. 7. Time in the market. Remember the saying, time in the market is more important than timing the market. By staying invested and giving your investments time to grow, you can benefit from the power of compounding without the need for market timing. And finally, number 8, accepting uncertainty. The market is inherently unpredictable. and no one can accurately time it consistently. Embrace this fact and focus on building a solid investment strategy rather than trying to outsmart the market. There you have it, 8 ways to bust the infuriating myth that you need to time the market. With these strategies and a long-term perspective, anyone can invest. The fifth limiting belief about stock investing is all stocks are the same. This belief ignores the fact that companies, industries, and economic sectors can behave differently in the stock market. Get ready for some explosive myth busting as I give you 10 ways to prove that not all stocks are the same. First up, market capitalization. Companies are classified as large cap, mid cap, and small cap, depending on their total market value. This has a significant impact on their risk profile and potential for growth, so don't tell me all stocks are the same. Number 2. Industry sectors. Stocks come from a wide range of sectors like technology, healthcare, finance, and many more. Each sector has its own characteristics, growth potential, and risks. It's absurd to think that all stocks are the same when they operate in such diverse industries. 3. Dividend versus growth stocks. Some stocks pay regular dividends to shareholders, while others focus on reinvesting profits for growth. These two types of stocks can have very different risk and return profiles, so lumping them together is just plain wrong. Fourth, value versus growth investing. Value stocks are often undervalued by the market, while growth stocks have higher than average growth potential. These investment styles focus on different stock characteristics, further providing that all stocks are not the same. Number 5. Geographic location. Companies are located all around the globe, and their stock are influenced by regional factors such as economic conditions, political stability, and currency fluctuations. Different regions mean different risks and opportunities. Sixth, company management. A company's leadership team and corporate culture can have a huge impact on its performance. Different management styles and strategies can lead to widely different outcomes for stocks, providing that they are not all the same. 7. Financial health. Companies have varying levels of debt, cash flow, and profitability, all of which affect their stock performance. Assessing a company's financial health is crucial to understanding the differences between stocks. Number 8. Volatility. Some stocks are more volatile than others, meaning they experience larger price fluctuations. This can impact your investment strategy and risk tolerance, further illustrating that all stocks are not created equal. 9. Business models. Different companies have different business models, target markets, and revenue streams. These factors can significantly affect a stock performance and potential for growth, providing yet again that all stocks are not the same. And finally, number 10, ESG factors. Environmental, social, and governance factors can influence a company's performance and reputation. Investors who consider ESG criteria recognize the importance of these differences between stocks. There you have it, 10 ways to burst the infuriating myth that all stocks are the same. With such a diverse range of factors affecting stocks, it's crucial to understanding these differences when building your investment portfolio. It's time to stop believing this ridiculous myth and start making informed investment decisions. The sixth limiting belief about stock investing is I can do it all on my own. Some investors believe they don't need professional advice or guidance when investing in stocks. While self-directed investing can be rewarding, it's essential to recognize the value of professional expertise. especially when dealing with complex financial instruments or market conditions. First up, learning from others. There is a wealth of knowledge to be gained from books, podcasts, YouTube channels, and blogs. Don't close yourself off from the experiences and wisdom of others who have been in your shoes. Number 2, mentors. Finding a mentor can provide invaluable guidance, support, and motivation. It's hard to put a price on the impact a mentor can have on your personal and financial growth. Don't be too proud to seek one out. And finally, number 3, embracing your limitations. Recognizing that you can't do everything on your own is a sign of maturity and self-awareness. Don't be afraid to ask for help and seek support when needed. By learning from others, finding a mentor, and embracing your limitations, you'll be well on your way to success in investing and beyond. The 7th limiting belief about stock investing is successful investing is only for the wealthy. Really? Small investments add up. You don't need a fortune to start investing. Even modest contributions can grow significantly over time thanks to the power of compounding. Don't let a lack of wealth be your excuse not to invest. Dividend reinvestment plans allow you to automatically reinvest dividends received from stocks, effectively compounding your investments over time. This strategy doesn't require a large initial investment and can lead to a significant growth. You don't need to be wealthy to invest in your own education, skills, and personal growth. By improving yourself, you'll be better equipped to succeed in investing and other areas of life. Generate extra income through side hustles or starting your own business. This can help you build wealth and create more opportunities for successful investing. And finally, persistence and patience. The key to successful investing isn't being wealthy, it's staying committed and patient over the long term. Anyone can achieve investing success with the right mindset and discipline. The 8th limiting belief about stock investing is investing in stocks equates to gambling. Many people perceive investing as gambling due to several factors. Risk. Both investing and gambling involve risk. In both cases, individuals put their money at stake with the hope of making a profit. This uncertainty can lead people to equate investing with gambling. Unpredictably, the financial markets can be volatile and short-term fluctuations can sometimes resemble the randomness seen in gambling. However, unlike gambling, investing relies on research, analysis, and long-term trends. Emotions. Investing and gambling can evoke strong emotions, such as excitement, fear, and greed. When people make decisions based on these emotions rather than rational analysis, they may perceive investing as akin to gambling. High-profile losses. News stories about significant investment losses can reinforce the notion that investing is similar to gambling. However, such losses often result from risky investment strategies or poor decision making rather than the nature of investing itself. However, it's important to note that investing and gambling are fundamentally different. Investing involves acquiring assets with expectations of generating income or appreciation over time, while gambling relies on chance with no guarantee of long-term returns. Responsible investing involves research, diversification, and a long-term perspective, which can help mitigate risks and increase the likelihood of achieving financial goals. The 9th limiting belief about stock investing is fallen angels will go back up eventually. Whatever the reason for this myth's appeal, there is nothing more damaging to novice investors than believing that a stock trading close to its 52-week low is an excellent purchase. Consider this in light of the well-known Wall Street saying, "Those who attempt to catch a falling knife will only get injured." Get ready for some explosive myth busting as I give you 10 ways to prove that fallen angels don't always go back up. First up, company fundamentals. Just because a stock price has dropped doesn't mean it's destined to rebound. Poor financials, weak management, and other underlying issues can cause a stock to keep falling or never recover. Don't be blinded by optimism. Number 2, industry changes. Sometimes entire industries undergo massive shifts that can leave once dominant companies in the dust. If a fallen angel operates in an industry that's fading, there's no guarantee it will rise again. 3. Market sentiment. A company's stock price can be heavily influenced by investor sentiment, which can be unpredictable and irrational. Just because a stock has fallen doesn't mean that market will suddenly change its mind and send it back up. 4th, competition. New competitors can swoop in and steal market share from fallen angels, making it difficult for them to recover their former glory. Don't assume that one successful company can always fend off new challenges. Number 5, poor management decisions. A history of bad decisions by a company's leadership can make it hard for a fallen angel to regain its footing. Be wary of management teams that have led a company astray. 6th, black swan events. Unforeseen events can wreak havoc on a company's prospects, making it difficult or impossible for a fallen angel to recover. Don't bank on a stock's recovery if the odds are stacked against it. 7. Structural changes. Companies can undergo significant internal changes that permanently alter their business models or prospects. Not every fallen angel will be able to adapt and rise again. Number 8. Bankruptcy risk. Some fallen angels may be teetering on the edge of bankruptcy, making a recovery highly unlikely. Don't ignore the risks and potential consequences of investing in struggling companies. 9. Opportunity cost. By focusing on fallen angels and hoping they'll rise again, you may be missing out on other, more promising investment opportunities. Don't let a stubborn belief in a stock's recovery blind you to better options. And finally, number 10, past performance is not an indicative of future results. Just because a stock was once a high flyer doesn't mean it's destined to reach those heights again. Base your investment decisions on current facts, not as historical glory. Investing in the stock market requires critical thinking and realistic expectations, not blind faith in a stock's resurrection. The 10th limiting belief about stock investing is stocks that go up must come down. It's outrageous, and I'm here to annihilate that myth. I'll show you 8 ways to prove that stocks that go up don't always have to come down. First up, long-term growth. Many companies have demonstrated consistent long-term growth. Define the myth that all stocks must eventually fall. Don't let this misguided belief hold you back from investing in solid, growing companies. Number 2, market leaders. Companies that dominate their industries can maintain their upward momentum for extended periods as they continue to innovate and expand. Don't assume that every market leader is bound for a downfall. 3. Dividends. Some stocks may experience price fluctuations, but they consistently pay dividends, providing investors with a steady income stream. Don't discount the power of dividends in a well-rounded investment strategy. 4th, strong financials. Companies with robust financials, such as low debt, strong cash flow, and healthy profit margins, are better positioned to maintain growth over time. Don't be swayed by the myth that all stocks must fall. Number 5. Innovation and adaptation. Companies that consistently innovate and adapt to changing market conditions are more likely to keep growing, even in the face of adversity. Don't let the myth of falling stocks discourage you from investing in forward-thinking companies. Sixth, economic cycles. While stocks may fluctuate during different strategies of economic cycle, some will continue to grow over the long term. Don't let short-term market fluctuations trick you into believing in this myth. 7. Blue chip stocks. These well-established financially sound companies often demonstrate long-term stability and growth. Don't let the myth of falling stocks deter you from investing in these reliable performers. And finally, number 8. Investing with a long-term perspective. Focusing on long-term growth and value rather than short-term fluctuations can lead to more consistent returns. Don't let the myth of falling stocks cloud your judgment and derail your long-term investment plan. The 11th limiting belief about stock investing is, I don't know which stock to pick. Many individuals hold this perception of investing, a savvy market expert who selects a winning stock and becomes a millionaire. This image is perpetuated by numerous media outlets that claim if you only had bought $1,000 worth of Google stock, you'll be a millionaire today. However, investing is not solely about picking individual stocks. In reality, an investor can achieve considerable success by purchasing and holding a diversified portfolio of stocks rather than focusing on just a single stock. With so much information available at your fingertips, there's no excuse for learning about different stocks and industries. Start by reading financial news, company reports, and analyst opinions. Knowledge is power. And you can also start well-known companies. If you're overwhelmed by the choices, begin by looking at familiar established companies with strong track records. Don't let indecision paralyze you from taking that first step. And remember, to learn from your mistakes. Every investor will pick up a few losers along the way. Use these experiences to learn and refine your stock picking process. Don't let the fear of making mistakes prevent you from investing. Picking a stock that beats the S&P 500 can be challenging, but by following these steps, you can increase your chances of selecting a winner. Begin by studying the market and identifying industries with high growth potential. Look for sectors that are benefiting from economics, technological, or social trends, as these often indicate opportunities for substantial growth. Analyze financial health of the companies within your chosen industries. Look for companies with strong balance sheets, low debt levels, and robust cash flow. Companies that exhibit solid financials are better positioned to outperform the market. Evaluate the company's historical and projected earnings growth. Stocks with consistently strong earnings growth are more likely to beat the S&P 500 over time. Seek companies with a strong competitive advantage or a unique value proposition. A competitive advantage can be in the form of innovative products or services, a strong brand, or cost leadership. Assess the quality of the company's management team. Effective leadership is crucial for a company's success and can significantly impact its social performance. Effective leadership is crucial for a company's success and can significantly impact its stock performance. Compare the company's valuation ratios, such as price to earnings, price to book, and price to sales, with industry peers and historical averages. While a lower valuation doesn't guarantee success, it can indicate a potentially undervalued stock with room for growth. The price-to-earnings ratio provides a snapshot of how much investors are willing to pay for each dollar of earnings generated by the company. A higher PE ratio typically suggests that investors have higher expectations for a company's future growth, while a lower PE ratio may indicate that the market perceives the stock as undervalued or that the company's growth prospects are limited. A price-to-book ratio lower than 1 may indicate that the stock is undervalued, as the market price is lower than the company's net asset value. Conversely, a PB ratio higher than 1 suggests that the stock is trading at a premium to its net asset value, which could mean the stock is overvalued or that investors have high expectations for the company's future growth. The price-to-sales ratio provides an indication of how much investors are willing to pay for each dollar of revenue generated by the company. A lower PS ratio may suggest that the stock is undervalued or that the company has limited growth prospects, while a higher PS ratio typically indicates that investors have higher expectations for the company's future growth. Keep in mind that the PS ratio does not take into account a company's profitability, so it is essential to consider other factors such as earnings and cash flow when evaluating a stock. The next step is, rather than solely focusing on one stock, consider building a diversified portfolio of high-quality stocks. This will help mitigate the risk of underperformance from any single stock. You must also keep an eye on your chosen stocks and the broader market. Be prepared to adjust your portfolio as conditions change or new information becomes available. Remember that outperforming the S&P 500 requires patience and discipline. Stick to your investment strategy and avoid making impulsive decisions based on short-term market fluctuations. There are no guarantees when it comes to picking stocks that beat the S&P 500, but by following these steps and maintaining a long-term perspective, you can improve your chances of success. The 12th limiting belief about stock investing is, I think the stock market is too high. First of all, market levels are determined by a complex interplay of factors, including productivity growth, interest rates, and economic conditions. Simplistic notions about the stock market being too high overlook these nuances. Remember that the stock market has historically trended upwards over time. While there may be periods of volatility and setbacks, a long-term perspective will reveal that market's growth is not solely a result of speculation. And also, stocks are priced based on their expected value cash flows. Market levels reflect investors' collective expectations about the future rather than just arbitrary valuations. Consider the impact of central banks' policies on the stock market. The low interest rate environment we've been in has made equities more attractive relative to bonds, thus contributing to higher market levels. Examine the role of technological advancements in driving stock market growth. Many leading companies are at the forefront of innovation, which has fueled their expansion and increased market valuations. Be aware of the inherent cyclical nature of markets. Economic cycles, credit cycles, and other factors contribute to fluctuations in the stock market, and it's important to maintain a long-term perspective. Remember that not all stocks are overvalued. Opportunities still exist within specific sectors or individual stocks, even if the broader market appears high, and value investing strategy is the best way to look for stocks in a bull market. Pay attention to the impact of inflation on stock market levels. Comparing historical price levels without accounting for inflation can lead to misleading conclusions about the market being too high. Lastly, focus on developing a sound investment strategy that aligns with your unique goals and risk tolerance. Avoid being swayed by emotional biases or the fear of missing out, which can lead to poor decision making. And last but not least, the 13th limiting belief about stock investing is, I don't have enough time to invest. Are you kidding me? You think you don't have enough time to invest? First of all, let's get one thing straight. You make time the things that matter, and investing should be one of them. Oh, you're busy? Well, so is everyone else. Make investing a habit. Set aside a small amount of time each month to review your investments and make adjustments as necessary. This incremental approach can make managing your investments less daunting and time-consuming. Invest a fixed amount at regular intervals regardless of market conditions. This strategy eliminates the need to time the market, reduces the impact of short-term volatility, and requires minimal time commitment. You know, you can learn from others, right? Study successful investors and adopt their strategies. Don't waste time reinventing the wheel. Value investing and growth investing are strategies that can be learned. Educate yourself, spend a little time learning about personal finance and investments. A strong foundation will save you tons of time in the long run. You can buy a good stock market online course or mentoring program. Focus on the long term. Stop obsessing over daily market fluctuations. It's a waste of time and energy. Set your goals and keep your eyes on the prize. Time is your most valuable asset when it comes to investing. The longer you wait, the more you miss out on the power of compounding. By not investing, you're potentially sacrificing future financial security and wealth building opportunities. So, enough with excuses. It's time to take control of your financial future. If you found this video helpful, give it a thumbs up, share it with your friends, and subscribe. Until next time, invest wisely and take charge of your life.